Everyone says the same thing when a recession hits. This is it. This is the moment. Prices are down. Opportunities are everywhere. This is when real wealth is made. And nowhere is that belief stronger than in housing. Because the moment home prices dip, something flips in people's minds. Suddenly, the house that felt out of reach now feels like a once-in-a-lifetime deal. Suddenly, renting feels like losing. Suddenly, buying feels like winning. But here's the part nobody slows down to think about. A recession doesn't just make houses cheaper, it makes everything else more fragile. And that's where the trap begins. Because at the exact moment people feel like they're getting a deal, they may actually be taking on the most risk they've ever carried in their life. Picture this. A couple in their early 30s, dual income, stable enough, or at least it feels that way. For years, buying a home never quite worked. Prices were too high. Interest rates were shifting. Down payments felt out of reach. So they waited. Then the economy starts to turn. Headlines change. Words like slow down, cooling, corrections start showing up everywhere. And then the big one. Home prices begin to drop. Not dramatically. Not like a crash. Just enough. Just enough to feel like a window is opening. And that's all it takes. Now the conversation changes. This might be our chance. We don't want to miss this. People who bought in the last downturn made so much money. And just like that, the emotional pressure starts building. Not fear of loss, but fear of missing out. They start browsing listings more seriously. Homes that used to be out of budget now look possible. The numbers seem to make sense at first glance. The price is lower. That feels like a win. But that's where most people stop thinking. Because the price is just one piece of the equation. And in a recession, it's often the least dangerous one. What's not being fully considered is everything happening in the background. The job market isn't as stable as it was a year ago. Layoffs aren't everywhere yet, but they're starting to appear. Companies are slowing hiring. Bonuses shrink. Overtime disappears. That quiet sense of security begins to erode, even if nothing has gone wrong yet. And at the same time, something else is happening that most people don't connect to their home buying decision. The cost of just living hasn't gone down. Groceries are still expensive. Gas is still high. Insurance, utilities, healthcare, none of these suddenly become cheaper just because home prices dipped. In fact, for many people, these costs have already stretched budgets thin. In many parts of the country, people are already spending 40%, 50%, even 60% of their income just to keep a roof over their head. Not to build wealth, not to save, just to stay in place. That's the environment this couple is making their decision in. But it doesn't feel that way, because the story they're telling themselves is simple. Prices are down, that means it's a good time to buy. And that story is incredibly persuasive. They run the numbers. The home price is lower than it was a year ago. That part feels like a win. But then comes the interest rate. It's higher than they expected. So the monthly payment, not that different from before. Sometimes even higher. But that's easy to rationalize. Rates will come down later. We can refinance. That belief carries a lot of weight. It turns an uncomfortable number into a temporary problem. It makes the decision feel safer than it actually is. So they move forward. They stretch a little. Not recklessly, just enough to make it work. The down payment takes most of their savings. Closing costs eat into the rest. The emergency fund shrinks, but it still exists, so it feels acceptable. And just like that, they become homeowners. On paper, it looks like progress. In reality, something much bigger has changed. Before, their housing cost was flexible. If things got tight, they could move. Downsize. Find a cheaper place, split rent, negotiate. There were options. Now, their housing cost is fixed. The mortgage payment is due every month. No negotiation, no flexibility, no pause button, and that's the shift almost nobody fully appreciates when they make this decision. Because renting feels expensive, but it's flexible. Owning feels stable, but it's rigid. And rigidity becomes dangerous when the environment is unstable. This is where the broader system comes into play. Because what's happening to this couple isn't happening in isolation. It's part of a much larger dynamic. For years, housing hasn't just been about shelter. It's been treated like an investment machine. Homes are bought, packaged, financed, leveraged. Entire portfolios are built on the assumption that housing values will rise and that payments will keep flowing. That system works until it doesn't. And the first cracks don't show up in prices, they show up in people's ability to pay. That's the part that makes recessions so different. Because the real risk isn't that home prices fall. The real risk is that income becomes uncertain. When layoffs begin, even slowly, everything changes. Not just for the people who lose jobs, but for everyone watching it happen. Companies get cautious, raises disappear, hiring freezes, side income dries up, the margin for error shrinks across the board. And this is where the timing becomes dangerous, because the same conditions that create opportunities in housing also create pressure everywhere else. The couple doesn't feel it immediately. For a few months, everything is fine. Payments are made. Life continues. The decision feels validated. Then something small happens. Not catastrophic, just enough. Maybe one income gets reduced. Maybe hours are cut. Maybe a bonus doesn't come through. Maybe an unexpected expense hits, a car repair, a medical bill, something that would have been manageable before. But now, the margin is gone. Because that's the hidden reality of the system most people are living in. It doesn't collapse all at once. It erodes quietly. One missed payment, then another, then a late fee, then stress. That's how financial pressure actually builds. Not with headlines, but with silence. And this is where the difference between renting and buying becomes impossible to ignore. If this couple were still renting, they would have options. They could adjust, cut costs, relocate, adapt. But now, the mortgage doesn't adjust. The bank doesn't care about the broader economy. It doesn't care about layoffs, or inflation, or unexpected expenses. The payment is due every month. That's the fixed cost risk. And it's one of the most dangerous forces in a recession, because when income becomes uncertain, fixed costs become pressure points. And housing is usually the biggest fixed cost of all. What makes this even more complicated is that the broader housing market doesn't always behave the way people expect during a downturn. There's this assumption that if home prices fall, everything becomes easier. But that's not how it works, because falling prices often come with tighter credit. Banks become more cautious. Lending standards tighten. Getting approved becomes harder, not easier. Refinancing becomes less certain. Selling becomes slower. So the very flexibility people expect to have after buying, like refinancing or selling if needed, becomes less available. That's the contradiction at the center of this entire decision. The environment that creates the deal also removes the safety nets. And that's what turns a good idea into a risky one. At the same time, something else is happening across the country that adds another layer to this story. People are no longer upgrading their lives the way they used to. For years, the mindset was simple. Move to a better place. Get a bigger home. Improve your situation. But now, the mindset has shifted. Now it's about holding on. About staying afloat. About surviving. People are downsizing, moving in with family, taking on roommates later in life, cutting back in ways that would have seemed unthinkable before. That shift matters, because buying a home assumes forward momentum. It assumes stability, growth, and predictability. But a recession is the opposite of that. It's uncertainty, contraction, and risk. So when those two forces collide, the desire to buy and the reality of the environment, that's where the trap forms. It doesn't feel like a trap at the beginning. It feels like progress. It feels like finally getting ahead. But the real question isn't whether buying during a recession can work. It's whether the conditions around that decision support it. Because sometimes the smartest financial move isn't the one that looks like progress on paper. It's the one that preserves flexibility when everything else is uncertain. And that's the part most people don't want to hear. Because renting feels like standing still. Buying feels like moving forward. But in a recession, standing still can sometimes be the move that keeps everything intact, while moving forward too quickly can lock someone into a position that becomes harder and harder to manage. And that's where this conversation starts to shift. Because this isn't really about renting versus buying. It's about timing, risk, and understanding what's actually changing beneath the surface. Because the biggest mistake people make in a recession isn't missing an opportunity. It's misunderstanding what kind of opportunity it actually is. Now here's where the conversation usually gets simplified in a way that hides the real risk. Because people love turning this into a clean comparison. Renting versus buying. One builds equity, the other doesn't. One is an investment, the other is an expense. It sounds straightforward, but that framing leaves out the part that actually determines whether the decision works or fails, especially during a recession. Because the real comparison isn't rent versus mortgage. It's flexibility versus commitment under uncertainty. And once that lens shifts, the math starts to look very different. Take the same couple and slow everything down. Instead of focusing on the home price, start with the full picture. There's the mortgage payment, which already reflects both the price of the home and the interest rate. And during a recession, even if prices dip, rates don't always follow in the same direction. In many cases, rates stay elevated or even rise, which means the monthly payment doesn't drop nearly as much as expected. Then layer in property taxes, insurance, maintenance, repairs, and all the small costs that don't show up in the initial excitement of buying. Suddenly, that deal starts to look less like a discount and more like a long-term obligation that's locked in regardless of what happens next. Now compare that to renting, which feels painful in a different way. Rent is money that disappears every month, and that's what makes it emotionally frustrating. But financially, it carries a hidden advantage that becomes incredibly valuable during unstable times. It allows movement. It allows adjustment. If income changes, lifestyle can change with it. If a job disappears, relocation becomes an option instead of a crisis layered on top of another crisis. That flexibility is often dismissed when things are stable, but in a recession, it becomes one of the most valuable forms of protection a household can have. And this is where the math that most people use completely misses the point, because it assumes stability. It assumes steady income, predictable expenses, and the ability to hold a property long enough for everything to work out. But a recession is defined by the breakdown of those assumptions. Income becomes uncertain, expenses remain high, and the timeline people thought they had suddenly shortens. That's when the question shifts from, is this a good deal, to, can this be sustained if things go wrong? Because sustainability is everything in this environment, there's a common belief that if a monthly payment works today, the decision is safe. But recessions don't test today's numbers. They test durability. Income can drop, hours can get cut, or a job can disappear entirely. These aren't rare events in a downturn. They're part of the environment. And that's where a reasonable decision can quietly turn risky. A mortgage stays fixed, but everything else around it can shift, making that same payment harder to sustain over time. As pressure builds, options shrink. Selling becomes harder when buyers pull back, and credit tightens. Refinancing, often seen as a safety net, becomes less accessible. At the same time, the broader system is under stress. When households are already stretched thin, even small disruptions can trigger bigger problems. That same lack of margin carries into homeownership, where the commitment is larger and less flexible. This is why the decision depends less on market timing and more on personal stability, cash reserves, and the ability to hold through uncertainty. And then there's the question most people avoid because it forces a level of honesty that's uncomfortable. Can the payment still be managed if things don't go according to plan? Not in a worst-case scenario, but in a realistic downturn scenario where income is reduced and expenses remain high. If the answer depends on everything going right, then the decision is already carrying more risk than it appears. What makes this even more important is how the broader housing system reacts under pressure. When rent becomes unaffordable for large parts of the population, it doesn't just create individual hardship, it creates system-wide stress. People double up, move out, stop upgrading, and demand shifts in ways that ripple through the market. That affects landlords, lenders, and ultimately the availability of credit. And when credit tightens, it doesn't just impact new buyers. It impacts existing homeowners who might need to refinance or sell. So the idea that buying during a downturn is automatically advantageous starts to break down when all these layers are considered together. It's not that buying is wrong. It's that buying without accounting for these conditions is where the real risk lies. Because the trap isn't the purchase itself. The trap is the narrative, the belief that lower prices automatically mean better decisions, the assumption that opportunity is defined by the market alone rather than by personal stability within that market, and the tendency to focus on the visible part of the equation while ignoring the invisible risks that come with it. In reality, a recession doesn't simplify the rent versus buy decision. It complicates it. It raises the stakes. It makes the consequences of getting it wrong more severe, not less. And that's why, in many cases, renting during a recession isn't falling behind. It's preserving the ability to respond to whatever comes next, It's keeping options open in an environment where options tend to disappear quickly. It's choosing flexibility over commitment when the future is harder to predict. At the same time, for those who do have stability, cash reserves, and a long-term horizon, a recession can still present real opportunities. But those opportunities don't come from the market alone. They come from being in a position to handle uncertainty without being forced into reactive decisions. That distinction is what separates a strategic move from a risky one. So the real answer to the question isn't a simple yes or no. A recession is not automatically the best time to buy a house. It's the best time to understand whether buying actually fits the reality of the situation, not the story being told about the market. Because in the end, the goal isn't to catch a deal. The goal is to stay in control. And the moment a financial decision removes that control in an unstable environment, it stops being an opportunity and starts becoming a liability. That's the line most people don't see until it's already behind them. And by the time it becomes obvious, the flexibility to fix it is usually gone. That's why the smartest decisions in a recession rarely look exciting. They don't feel like big moves or bold plays. They feel cautious, measured, sometimes even frustrating. But they're built around one idea that becomes more valuable the more uncertain things get. Survive first, optimize later. Because once stability is secured, opportunities can still be taken. But when stability is lost chasing an opportunity, recovering from that position becomes much harder than simply waiting for the right moment in the first place. And that's what separates the people who come out ahead from the ones who get caught in the trap. The decision isn't about timing the market perfectly. It's about making sure the market can't break the decision. That's the difference. And that's what most people miss. If this breakdown helped reframe how this decision actually works, consider subscribing and turning on notifications for more deep dives into the financial realities shaping everyday decisions. Because the next shift in the economy won't announce itself loudly, and understanding it early is often the only advantage that really matters.